tax return mistakes landlords make. If you are a landlord in the UK and you file your own tax return, there is a high chance you are either overpaying tax or risking penalties from HMRC by making one of these mistakes. Mistake number 3 to number 5 are the ones that are catching landlords the most. Hi, my name is Amma, a chartered accountant and a tax professional from AB & Co Accounting and Tax Services. Let's get started. The first mistake is not claiming all allowable expenses. It will surprise you to note that according to HMRC's data, 87.7% of unincorporated landlords claim some kind of rental expenses. The emphasis is on some kind of rental expenses. Does it then mean that 12.3% of unincorporated landlords never claim any expense at all? Let me know in the comment section. According to the same HMRC data, the most common categories of rental expenses claimed against rental income are insurance, rates, repairs, and maintenance. Whilst there are a lot more expenses that can be claimed against rental income, these 3 are the most prominent, which means unincorporated landlords are missing out on a lot of expenses they are not claiming against their rental income. Not claiming all allowable expenses can lead to overpaying tax, as previously indicated. Have you ever missed any of these expenses before? Let me know in the comment section. Mileage to and from the property, letting agent fees, cost of advertising for tenants, Airbnb fees, accountancy and professional fees, service charges, ground rents, bank charges, foreign exchange fees, tenants eviction costs, use of home as an office expense, replacement of domestic items cost, safety certificates, phone costs related to the property. The list can go on and on. It's time to pause and ask yourself, do you need a professional to look after your tax affairs? If you miss any of these expenses, you are leaving money unconsciously to HMRC. For example, a landlord who is a higher rate taxpayer missing £3,000 in expenses could mean paying at least £1,200 to HMRC. And I say at least because the tax rate for rental profit is increasing soon. The next mistake is even worse because landlords don't realize they are doing it. And that is confusing repairs with improvements. This one causes serious problems because this can lead to you submitting an incorrect and an inaccurate tax return to HMRC. If HMRC identifies that you have submitted an incorrect tax return, you could face up to 30% in penalties. There is a clear distinction between repairs and improvement. Repairs are allowable expense against your rental income. Improvements are capital costs, and that can only be claimed when you sell the property. For example, replacing broken kitchen units like for like is a repair. Upgrading to luxury bespoke kitchen is an improvement. But here is the twist. Sometimes what looks like an improvement can qualify as a repair if it is more than equivalent replacement. There are complex rules when it comes to this area, and this is the area you may consider seeking professional advice. The next mistake is where landlords get caught out, and that is not understanding Section 24 of UK's Finance Act 2015 mortgage interest relief. This particular one is a profit killer. Under this rule, you can no longer deduct the mortgage interest as an expense, but rather you can obtain a 20% relief against your tax. You can obtain this 20% relief by entering the total mortgage interest paid per tax year under the relevant section of the UK tax return. You cannot enter the total mortgage payment. Please note, only the mortgage interest and not the capital repayment. Most landlords make this mistake by entering the total mortgage payment, which includes the capital and the mortgage interest. This does not apply if you manage your property portfolio under a company structure. Companies can continue to claim the entire mortgage interest as an expense. Mistake number 4 makes things even worse, and that is ignoring capital gains tax planning in advance. Most landlords only consider income tax and ignore capital gains tax, and so they get hit the hardest when they sell the property. Common capital gains tax mistakes are not using your annual exemption amount, not transferring ownership between spouses before selling the property, forgetting to report the sale within 60 days of completion, miscalculating allowable capital cost. These are some of the common mistakes landlords make, and if you make any of these mistakes, it can lead to you paying a huge amount of capital gains tax. For example, on a gain of £100,000, that's potentially up to £24,000 in tax to HMRC, depending on your tax band. Plan ahead, seek professional advice, as this can reduce the tax that you pay to HMRC. You can always contact us if you need any help regarding your property taxes. The next mistake is the one that triggers HMRC's investigation, and that is keeping accurate and an up-to-date records. HMRC only works on evidence and documentations. Therefore, without accurate record keeping and documentations, HMRC will reverse every expense that you have claimed. You could also face penalties. HMRC can investigate you up to 4 years for normal errors, up to 6 years for carelessness, up to 20 years for deliberate misstatement. If you cannot prove every expense with documentations, HMRC can deny them. Digital bookkeeping is no longer optional, especially with making tax digital for income tax expanding. If you fix just 2 of these mistakes, you could reduce your tax significantly. This video here will provide you with reliefs you can claim when you sell your property. Contact us to look after your property portfolio for a maximum tax reduction, or speak to your own accountant or tax advisor. If you found this video helpful, let us know in the comment section. And don't forget to subscribe and hit the like button for more tax tips such as this. As always, this is not a tax advice or any form of advice and should not be relied upon as a tax advice. For tailored advice, please speak to your own accountant or tax advisor or contact us. Thank you for watching. See you in the next one.